with the recent attack on Iran. We're going to talk about what the impact for investors is. Join us for Something More with Chris Boyd, and we hope you'll subscribe and like.
Welcome to Something More with Chris Boyd. Chris Boyd is a certified financial planner practitioner and senior vice president financial advisor at Wealth Enhancement Group, one of the nation's largest registered investment advisors. We call it Something More because we'd like to talk not only about those important dollar and cents issues, but also the quality of life issues that make the money matters matter. Here he is, your fulfillment facilitator, your partner in prosperity, advising clients on Cape Cod and across the country. Here's your host, J. Christopher Boyd.
Welcome, everybody. Thanks for being with us for another episode of Something More. I'm here with Brian Regan and Russ Ball. All of us are on the AMR team at Wealth Enhancement, and glad to have you joining us. When there's disruptions in the world, in this case, we've had recent events with Israel and the U.S. bombing Iran. Naturally, it creates concern for investors, and we're going to talk a little bit about, is there something you should do? What's the impact? What might we expect as we look ahead? Very early in this process, as we record this conversation Monday morning, March 2nd. Brian, I'm going to start with you and look to you to give us some thoughts on this. When you hear about something like this, naturally, sometimes investors think, gosh, maybe I should be selling. Maybe I should get more conservative. Maybe I should be buying defensive stocks. Like certain kinds of thoughts are common. Let's start with some big picture perspective. How should we think about occasions like this? Is it generally a good idea to make some dramatic change in one's portfolio given the uncertainties that may arise from conflicts?
It really hasn't made sense to do anything in your portfolio for any kind of international skirmish outside of the Russian-Ukraine war, which I would say isn't a skirmish. That's a full-blown war that's lasted multiple years here now, right? So that's clearly the risk here, that this lasts a lot longer than we hope. I believe the president's come out and said that 4 or 5 weeks would be not unreasonable, but he's one to change his mind pretty regularly as well. So I think this is...
and it may not be entirely within his control as to how long this will last, right? I mean, once you open the can of worms, you don't know exactly what will happen.
You don't know if it's going to get more widespread. I mean, if you use your imagination, it can go to wild places. But, if you sit back and look at the facts on the ground, I think the expectation is that this will not last for years like the Russian-Ukraine war. Probably for weeks, and worst case scenario, months. And what do I say? I mean, that's been the case for anything involving Israel and Iran for years, right? I mean, we had a 7-day war, we had a 6-day war, we had a 12-day war. That seems to be how long these last. Why? Because Israel and the United States are significantly overpowering Iran. I don't think there's really much doubt in that. So it's just a matter of when this gets resolved. And we've seen the market react kind of as expected. It's Monday morning, as Chris mentioned. I think it's important to timestamp this. Oil is up about 7%. So you'd expect, a pretty dramatic
surprising.
As 20% of the world's oil can't get through the Strait of Hormuz, which is the 21-mile stretch that connects the Iran ports to the Gulf of Oman. So that's not surprising. If that is prolonged, you should expect that oil prices will probably continue to go higher. And that could have a negative economic effect on parts of the economy. So it's something that you want to keep in mind. When I look at our client portfolios and our portfolios, we have energy exposure, so we have stocks that are up today. We have defense exposure, so we have individual stocks that are up today. Namely, Lockheed Martin is a position of ours in an individual stock portfolio. Cheniere Energy is a position for us in the individual stock portfolio. They're both doing very, very well today. Part of the reason is that the biggest natural gas refiner in Qatar was hit by Iran, and it's closed down right now. So those are doing well. But also, interestingly enough, like we have software stocks up. Software stocks have been getting killed for the last 3 months, and they're notably up. Why? Because they have nothing to do with what's going on with Iran. And if you're looking to sell something and buy something, it's a logical place where you could think that the economics will be unchanged by this event. So the biggest thing that I look at when I look across our portfolios is we're diversified. We have international stocks, we have domestic stocks, we have stocks in across sectors, whether it be more aggressive or staples or utilities or energy. We're involved basically everywhere, and that's because you don't know what's always going to happen, and it's good to be diversified. And finally, most notably, gold continues to do well. And as these geopolitical tensions continue to be on the boilerplate, gold has done well, and we've continued to benefit from that. So, one of the biggest things that I would be looking for would be an increase in inflation if this war goes on. I've said many times before that war is inflationary, and short-term skirmishes probably will have no effect, and oil will likely go down. But the fact that oil is up 8% and possibly could go higher is very notable. I mean, people might not know this, but plastic is made from oil refining remnants. Like the distribution of all your goods requires oil and gas to get in the airplanes, to get in the cars, to get in the ships. It's a very important input in the economy, and if you slow that down dramatically for some time, you're going to have cost increases. And we already have a kind of an unsettled inflation situation, and this could make it worse. So that's something that you want to monitor. So, I'm a little heartened today that nothing out of the ordinary is happening in the markets. Seems fairly orderly. I mean, yeah,
Like a measured response. Yeah. Yeah. No.
down a little bit, but nothing crazy that you wouldn't expect. I'm happy that I feel like our portfolios are very diversified. We have parts that are actually benefiting. And finally, I know that you guys do a great job making sure that clients are in the right risk profiles, and they're probably comfortable with the amount of risk that they're taking today, and sleeping well at night.
Well, that's a good place to transition to Russ to comment about this. I think that's an important point to be thinking about one's allocation. Brian talked about the notion of diversification and asset allocation. Maybe you want to elaborate on some of those points when it comes to the investors' preparation for events like this.
I think it's natural for investors when they see, something so dramatic pop up on their phones, Saturday morning, that possible war with Iran, like the knee-jerk reaction is to be, oh my gosh, what about the stock market? Everything's going to tank. We've seen this time and time again in history where these geopolitical events seem monumental. But I was looking at a chart or a table that Wealth Hansen put out this morning, and I think Ryan kind of mentioned something to this effect. But typically, these types of events have a average of a 6% drop over the next 17 trading days. So there is an immediate reaction, which is probably typical, and then a recovery 16 days later. It's not like these geopolitical events typically have long-lasting impacts, and you see this time and again on different charts that JP Morgan puts out and others, where you see the blips of the all the geopolitical events over time, and the market keeps going up. So I think it's important to put it into perspective. It can be scary when there's this uncertainty, and it's definitely the case with this current administration. There have been a lot of moments where we think we know something and then we don't, and things change constantly. And that's unsettling for markets and unsettling for investors. But we have a game plan for clients. We have a game plan for your asset allocation. As you heard from Brian, we have diversified strategies that are looking to take opportunities where they can, and also reduce risk where possible. So for those people who are thinking this is one thing too many, it's time to get out of the market, don't be one of those people. I think it's time and time again been proven to be the wrong reaction to pull out entirely. We can talk to you about your allocation and where you stand.
Yeah, I would add to that. in recent episodes of the program, we've talked about the idea that markets are still relatively high, even though they're not may not be at a particular moment at their high. That it hasn't been an unreasonable thing to consider doing a rebalance. If you said, "Oh, I want to take a little risk off," an incremental change. It's always better to do that before markets decline dramatically. Now we're seeing some decline, but it's not outrageous. It's still viable. If someone said, "I want to scale back a little bit of the risk," how to do that is important. To talk about when to do that might be worth talking about. Looking at your own liquidity availability might be a part of that conversation. Making sure that if you have sufficient liquidity, maybe you can be more measured in that. On the other hand, it may be important to make sure you have the resources you need, the liquidity available. So these are things we like to talk to people about specifically in their circumstances and their portfolio fits into their overall financial plan. Brian talked about diversification, and asset allocation is a diversification of how we invest in different asset classes, really. And so we do that because we want to have more predictability about what's going to happen with the movement of the portfolio. If we have everything in stocks, we are going to have more volatility. Volatility is normal. It's a normal part of the investing experience. And sometimes that volatility is appealing and upward moving. Inevitably, there are times when it's downside movement. Your comments, Ross, about inevitably markets tend to move higher over time. And we've had experiences where market declines tended to be short-lived in the last decade or two, and that's appealing. That they come back relatively fast, but that's not always the case. I think when you look at what this is, the cause of this in this immediate environment, as Brian said, because right now this is expected to be short-lived, you'd expect some of the volatility to be short-lived as well. However, what we want to be thinking about is long-term effects. What if there are disruptions long-term? And not because of this necessarily, just in general as an investor, make sure we've got the right resources for you in terms of this is why we want some liquidity, because volatility is inevitable. And we want to be in a position where we don't have to be a seller when it's inopportune. I'd like to go back to some of the things you said, Brian. And, I want to elaborate as well for our listeners. When we're talking about the portfolios that you're describing, Brian, we're talking about portfolios that we as a team have discretionary management. And there are, for people who may not be familiar with our team or wealth enhancement, there also exists strategies that the central managed team at wealth enhancement put together, which are slightly different, but probably common in theme in that we are trying to be well diversified in the way your portfolio is managed. And whether it's the strategies we're discussing or the strategies that are managed more centrally, you're having the same kinds of concepts play out that you want to have a broadly diversified portfolio. And that means being in different industries, whether it's with individual stocks portfolios or fund-based strategies. You mentioned oil and the price of oil, and I thought it might be worth for a moment for you to elaborate. And by the way, anyone who watches the series Landman knows that petroleum is in everything, right? If you've seen that show. When it comes to oil stocks and this potential disruption of oil supply coming out of the Middle East, what's the impact on oil stocks when oil prices rise?
I'll answer that, but before I get into it, I think it's notable that the stock market's only the S&P 500 is only down 20 basis points right now as we
Which
speak.
is not a big response. So, again, that goes back to that point about if someone is concerned, maybe still not a bad idea. If you think you've got too much risk in your portfolio, it's not too late to deal with some of these issues.
So oil is a commodity, right? There are companies called upstream drillers, which their job is to explore and to drill and find oil and sell it, right? And they're going to be the ones the most impacted, going to be the most volatile in that space. I think ConocoPhillips is like a pure upstream driller, right? Then there's midstream, which is typically pipelines. So you got to get the oil from one place to another. You have pipelines; those are called midstreams. They'll be impacted as well, but less so. And the reason being is if the price is high, they're going to drill more and they're going to flow more through the pipes, and they'll be able to charge higher rents. So you would think that they would be the least involved in the price of oil, but I've made that mistake in the past, and they are very much affected by the price of oil and trade with the price of oil to some degree. And then there's downstream. So downstream is your refiners, they're your gas stations and things like that, right? And each level takes an economic cut. So as you can imagine, when you see oil prices go higher, they're going to sell their products for a higher cost. It's going to hurt the consumer, me, you, and everybody else. But it might be good for employees in West Texas, for example. It might be good for companies in West Texas. They might experience a boom. And one thing about the United States here is we're in a very diversified economy. So while we might be suffering with higher gas prices up here in Massachusetts and Texas, they might be doing just fine because of the high gas prices. So it doesn't affect everybody the same. I think that's important to note. It's one of the ways that the economy has changed over the years. This was not the case, in the late 90s, and it's very much the case today. And I think that's, important to note that just where high gas prices used to be really troublesome for GDP, it's not necessarily the case today in the United States as it once was.
We quarterly do planned adjustments to our portfolios. We try to be forward-looking. You're very adept at kind of reviewing what's happening in economic trends and looking for valuation, different industry areas, and where there might be opportunities versus risks, and how that might play into the themes as we invest in our team strategies. Sometimes when there are events, um, the pandemic as an example or something, we are more inclined to make some adjustments. I get the sense this isn't one of those occasions where you're looking at what's happening in the world right now and saying, "Oh, you know what? I want to get in on this or that as a way to impact the portfolio." Is that a correct impression that we've got some places, as you mentioned, you've already been in software and some parts of the portfolios, and you've kind of already looked for opportunities? Is it just time to let those themes play out? Or for the person who's doing it on their own, why is it not necessarily a great idea to go buy those oil stocks or defense stocks or something like that? Or is it?
A lot of good points there. Usually we make mid-quarter adjustments when there's some kind of liquidity event. Luckily, that hasn't happened too often in my tenure with working with you, Chris. Maybe a couple of times that you mentioned the pandemic, Russia-Ukraine war, things like that, where outsized opportunity and risks, kind of collide together. When you're making a kind of a tactical change, you want to make the on ramp is usually pretty obvious, right? We got a skirmish in Iran, oil prices higher. It can be tempting to jump on that bus. You need to have an off ramp as well. How do you know that if we stop bombing this afternoon and oil crashes by 9%, you're going to lose money under that circumstance, right? So I think you need to have an idea of how to get off just as much as you do on how to get on. Getting on is easy and it's tempting, but the scenarios on making sure that you don't lose money on a tactical trade are just as important. I think one of the big ones that we do and I talk about a lot is gold. Gold has been surging for years now, and one could argue that I was very late to that. And the problem was the reason why we didn't get into it is I didn't see an off ramp. and that might have been very frustrating to the team and clients. But I want to make sure I'm not losing people money first and foremost. And
Yeah.
my concern in that situation was that the price was going up because there was a lot of central bank buying, and because of that, it led to a lot of momentum investor buying, and I didn't want to get whiplashed. And the way that made sense to me was my interest rate argument that I've made over and over again. And as that idea stops playing out, then I'm going to get out of gold, and I have an idea of what that off ramp is like. So if you're going to make that kind of adjustment to your portfolio, I would make sure that you know what your off ramp is. Uh, you know, I have no intentions of making any changes with oil and gas or with aerospace and defense. One, because I already have exposure to it. That very clearly in the individual stock portfolio, but since we're very diversified in the ETF and mutual fund portfolios, we have exposure there as well. And secondly, when's this going to end? How's it going to end? I don't know. And what's going to happen, right? So I think those are things that you want to keep in mind if you're playing this at home.
I was thinking also about one of the reasons we have diversified portfolios. We talk about the benefits of fixed income as having typically offer an element of stability when there's anxiety in the market. What's going on with the bonds? Is the bond part of the portfolio providing investors what they might expect? A ballast to the anxieties. You've said the market isn't all that disrupted right now. What's happening in the way of fixed income?
You make a good point. I mean, the stock market, the S&P 500 hasn't really done much so far year to date. After today, we're maybe going to be up like 0.5% if today finishes out the way it is today on the year, which is not terrible, but it's not what we hope for. But the bond market's up, more than 1.5%. And the international markets are doing very, very well. So, when I look across our portfolios, for example, we're doing pretty well, right? Across the board, because we have this exposure to international and good fixed income investments. One thing that has been under pressure lately is the credit oriented fixed income, which we don't have much exposure to at all, most notably private credit. And I'm glad that you brought this up, Chris, because the Iran-US situation, I'd say, is number 3 on my concerns today. Private credit is probably number 2, and getting a return on AI is probably number 1, right? These are things that I don't have any control of, other than the fact that I don't have to have any exposure to private credit. We've chosen not to for a long time. I'm going to continue to choose not to. It seems like a good idea. It has been a good idea. And we're going to have, we're going to make sure that our fixed income portion is that ballast that you mentioned.
Going back to the financial planning, big picture type stuff, when we do these plans, we take a look at what would happen if the market dropped by not 6% or 7%, but we look at what would happen if it dropped by 20%, 30%. And so we take that into consideration. We're not thinking it's just going to be a smooth ride up. We stress test, we look at different variables, and on the whole, most plans we look at are still structured in a way that there's still success if there is an immediate impact on the market. When I'm looking at this table that has a number of different geopolitical events over the last, I don't know, what is this, 60, 70 years, going back to Pearl Harbor, Gulf War, 9/11, there are 10% drops, 20% drops, but not much more than that. So, when you take a step back, it's easy to get sucked into the noise and the sort of fear around these types of things. But remember, we're looking at all this. We are stress testing. We're looking at the big picture and how things play out over the long term, not just immediate.
We've been through some really big, dramatic declines. Investors who've been invested over the last 30 years. The kind of extremes we saw in the early 2000s in the aftermath of the tech bubble, terror attacks of 9/11 sent us into a more severe decline than we had soon after the financial crisis in 2007, 8, 9. These were extreme events. It's not as likely we're going to have those kind of extreme events as frequently. For markets to go down 20% is not unusual, and investors should expect that their stock part of their portfolio should be able to withstand that kind of decline predictably. So that may be why not to be all in stock, right? Is how much you have in stock. Your point is a good one. Ultimately, this is best done in the context of your financial plan, so that you know how to be planning for your cash flow needs, and how to address your long-term financial security. And if we can be a resource in helping you to do that, don't hesitate to reach out to our team directly, which will give you the information on our show credits on the way out. All right, with that, guys, thanks so much. Appreciate your insights today. And for any of our clients who may be listening, if you have concerns, don't hesitate to reach out. We're always here to be a resource to you. Until next time, everybody, keep striving for something more.
Thank you for listening to Something More with Chris Boyd. Call us for help, whether it's for financial planning or portfolio management, insurance concerns, or those quality of life issues that make the money matters matter. Whatever's on your mind, visit us at somethingmorewithchrisboyd.com or call us toll-free at 866-771-8901. Or send us your questions to amr-info@wealthenhancement.com. You're listening to Something More with Chris Boyd Financial Talk Show. Wealth Enhancement Advisory Services and J. Christopher Boyd provide investment advice on an individual basis to clients only. Proper advice depends on a complete analysis of all facts and circumstances. The information given on this program is general financial comments and cannot be relied upon as pertaining to your specific situation. Wealth Enhancement Group cannot guarantee that using the information from this show will generate profits or ensure freedom from loss. Listeners should consult their own financial advisors or conduct their own due diligence before making any financial decisions.